All right, let's talk taxes. If you're a freelancer or a contractor here in Canada, you already know tax time can be, well, a bit of a nightmare. But what if it didn't have to be? Today, we are going to decode the essential tax deductions that can actually save you a ton of money. Okay, let's just get right into it. You know, figuring out your business expenses can feel like trying to solve a giant, complicated puzzle. What can you actually claim? What kind of records do you really need? It's a huge source of stress. I get it. But honestly, just understanding the basic rules is the first and biggest step to maximizing your return and, let's be real, lowering that tax bill. So here's our game plan. We're going to break this down into 5 simple parts. We'll start with the absolute basics, the rules for everything. Then we'll tackle the big ones like your car and your home office. After that, we'll cover all those everyday items and wrap it all up with travel expenses. It's a super clear roadmap to understanding your deductions. Okay, first things first, the basics. You absolutely have to get these core ideas right because they apply to every single expense we're going to talk about. Think of this as the foundation for your entire tax strategy. So the first big thing to wrap your head around is the difference between what the CRA calls a current expense and a capital expense. A current expense is something that gives you a benefit right now, this year. Think your phone bill or office supplies. You get to deduct the whole cost immediately. But a capital expense, like a laptop or maybe some big piece of equipment, is something that's going to last a while, so you can't deduct it all at once. Instead, you deduct a piece of its cost over several years. That's called the capital cost allowance, or CCA for short. Now this, right here, is the simple checklist for absolutely everything. For any expense to be deductible, it has to pass these 3 simple tests. 1, you spent the money specifically to earn business income. That's the whole point. 2, the amount has to be reasonable. You know, you probably can't claim a Ferrari to make local deliveries. And 3, and this is the big one, it can't be a personal expense. That line between business and personal has to be super, super clear. All right, let's hit the road and talk about a huge deduction for so many self-employed people, your vehicle. If you use your car for work, a chunk of all your running costs, gas, insurance, repairs, can be a major deduction. The key to all of it, though, you gotta have the paperwork. And when I say paperwork, I mean a logbook. The CRA is serious about this. But don't worry, it's not as bad as it sounds. Just remember these 4 things. First, write down your odometer on January 1st and December 31st. Then, for every single business trip, log the date, where you went, why you were going, and how many kilometers it was. At the end of the year, you just do some simple math to figure out what percentage of your total driving was for business, and that's the percentage of your car expenses you can claim. Easy, right? And here's a cool little shortcut the CRA gives you after you've done it once. The full logbook is, well, it's exactly what it sounds like. You track every trip all year. But once you've done that for one complete base year, you can switch to the simplified method. This means you only have to keep a detailed log for a 3-month period each following year, as long as your business driving stays pretty consistent, within 10% of that first year. It's a perfect example of how doing the work up front can save you a ton of hassle down the road. Next up, let's talk about the place where so many of us spend our workdays, the home office. I mean, if you're working from home, a part of your household bills can actually turn into some pretty sweet tax deductions. Your workspace can literally pay for itself. Now, to get this deduction, you only have to meet one of these 2 conditions. Just one. The first one is the most common. Your home is your main place of business. Basically, you spend more than half of your working time right there. The second one is a little different. It's for people who might have another office somewhere, but they also have a space at home that is used only for business and where they meet with clients on a regular basis. So how do you actually calculate this thing? Well, it all starts with a simple percentage. For our example, let's just use a nice round number to make it easy. The logic here is really straightforward. You just measure the square footage of your office or your dedicated workspace, and you divide it by the total square footage of your house. If that works out to be, say, 10%, then you get to deduct 10% of your eligible home expenses. And that includes things like your heat, your electricity, home insurance, and yep, even a part of your rent. Okay, let's get into the stuff you use every day to keep your business going. This category can be a little confusing, especially when it comes to something like clothing, so let's clear the air on this one. And I mean, let's just get it straight from the horse's mouth. This is a direct quote from the CRA, and it is a hard and fast rule. Even if your job requires you to buy specific safety shoes or a uniform, you generally can't deduct it. The CRA sees it as a personal cost. There are a few very, very specific exceptions, but for 99% of us, clothing is a no-go. So what can you deduct? The best way to think about it is consumables, stuff you literally use up while doing your job. So we're talking about basic office supplies like pens, paper, and ink cartridges. Cleaning supplies for your workspace totally count, or even items that get consumed as part of your service, like, say, drill bits if you're a contractor. When it comes to tools, though, there is a magic number that you have to know, and this number completely changes how you claim the expense. This table just lays it out perfectly. If a tool costs less than $500, boom, you treat it like a current expense and write off the full amount the year you buy it. But if it's $500 or more, it flips over into being a capital expense. You'll have to add it to something called Class 8 and claim that depreciation, the CCA, over a few years, just like we talked about with the computer earlier. And for our last section, let's cover those costs that pop up when you're on the move for your business, whether that's just across town for a meeting or all the way across the country for a big conference. If you're traveling away from home to earn business income, you can absolutely deduct the costs of getting there and staying there. So that means your flight, your train ticket, your hotel room, and your meals all count. But you'll notice that little note on the slide. There is a really important limit on that last one. And here it is. This is the crucial number. Whenever you're thinking about business meals, drinks, or entertainment, you have got to remember this percentage. That's right. Whether you're taking a client out for a nice dinner or just grabbing a sandwich at the airport during a business trip, the CRA says you can only deduct 50% of what you spent. This is one of the most common mistakes people make, so definitely make sure you apply this limit when you're adding up all your expenses. So after all that, what is the one single thing you need to take away from this? It's simple. Documentation. The absolute golden rule of business expenses is that if you can't prove it, it didn't happen. So keep every single receipt. Keep your logs clean and organized. When in doubt, just write it down. If the CRA ever comes knocking, your records are your absolute best defense. We've covered the what and the how, from the basic rules all the way to the nitty-gritty of your car, your home office, and travel. You now have the knowledge to have a much less stressful tax season. So the only question left is for you. Are your records ready for it? Thanks for tuning in.